Nick, how are you doing today?
I'm doing great, Gilbert. Thanks for the opportunity to speak to your audience. It's a pleasure to be here.
Indeed. I think we'll talk about this today, sort of into two parts. The first, maybe focus more on the macro, the markets, how things are going, because there's so much things going on here in the first half of the year, and then we touch upon some metals, of course, the battery metals that we wanted to talk about too. So is that fine with you?
Happy to do so. I should have put a fire background behind me so we had an actual fireside chat.
Yeah, indeed. We're missing the fire beside me, and we'll do this virtual one. So maybe the first one, obviously, the what's going on in the marketplace these days. The major headline is the bank failure. Some of the regional banks so get bigger and bigger. Seems like are we near the end of it? What's your thoughts? Because we have two parts. For there's two camps. So one camp is saying, okay, this is pretty much the end. The other camp say, hey, the worst is yet to come. So what would be your thoughts on this whole thing, how this developing?
Yeah, I think there's more to come. I'm not necessarily a doom and gloom guy, but if you look at a couple of things, it shows that the banks aren't out of trouble yet. First of all, you've only had 3 bank failures so far, and already the total assets that they controlled are larger than the bank failures we saw in all of 2008. So that tells me that something bigger is going on here. And then if you look at the index of the regional banks, like the KRE ETF, for example, you'll see that it's already lost 50% of its value, and it has not yet put in a bottom. So it's not going to be a V-shaped recovery for the banks. It's going to be a process to play out. At the same time, you've got a Fed who has yet to pivot. They just raised rates a quarter point this month. And while you'll likely see a pause over the next couple of meetings, you're still in a relatively high interest rate environment, given what we've seen for the past 10 or 12 years with 0 interest rates. The Fed is also still tightening, and you have a debt ceiling fight that's going to materialize here in the next couple of weeks. That's going to take liquidity out of the system, and so I think there's more trouble ahead for the banks as these the bonds that they put money into remain underwater, and we have to see what the Fed is going to do over the next couple of months here. The other thing I'd say is that this has really been a liquidity issue, right? Especially in the case of First Republic. We saw almost a classic bank run where you had Peter Thiel telling his associates and colleagues and friends to take money out of First Republic, and they had to sell their bonds that were underwater to meet those redemption requests. And what I think you'll see is that this is going to morph into also a bit of a real estate problem here, especially on the commercial side, where some of these banks hold commercial loans or have securitized commercial loans in these buildings that are now 50 to 80% vacant after the pandemic, and people have continued to work at home. So I think you'll see it more from a liquidity issue, a bond issue, to a real estate issue here over the next 3 to 6 months, and I would expect some more banks to go under.
That's good reason behind that too, and you mentioned about the Fed raising the interest rate. Obviously, it's a big thing going on. I was always wonder why the Fed, even currently right now, still try to raise because of this bank collapses. Because we all know one of the main factors is because of the interest rate increasing so fast. They made the wrong decision and put in the bonds, and that's sort of how you're all spiral out of control. So why do you think the Fed just have to keep raising the rate? We haven't seen the end of it yet.
Well, I think a couple of things. I think Chairman Powell is committed to being hawkish and to getting inflation down. He was very straightforward about the fact that there would be pain ahead. If you think back to a couple of Fed meetings ago, he said that there will be pain. And as a result, things have started to break. I think that the Fed has a dual mandate, right? They have their inflation mandate, which they'd like to get down closer to 2%. And, CPI just came out yesterday and it's still up close to 5%. So they haven't made enough progress. At the same time, unemployment is still really strong because it's a lagging indicator. And so I think that the Fed feels that it has room to continue raising because, unemployment is still so low. I also think the Fed is a bit behind the curve, right? The inflation numbers that we get are from a month before, right? Or 2 months before. And so they don't see the data ahead of time. So they're reacting to things that are in the past. I think that, once unemployment starts to tick up, which it will, I think we'll talk about recession here in a couple of minutes. That's sort of the end of the cycle. The economic cycle always ends with, rising unemployment. And so once that starts to happen, it will give the Fed cover to finally, pause for an extended amount of time or maybe even cut as we get into the fall months in September and October. But until that happens, I think the Fed is intent to keep rates or content to keep rates where they are. I don't think they care too much about the small banks. It's good for them if the banking power is concentrated, right? And so what you've seen is JP Morgan become almost the third arm. You have the Federal Reserve, the Treasury Department, and JP Morgan, who they've turned to absorb these banks as they fail. And so having a private partner in JP Morgan allows the Fed to, enact their policy more efficiently because they have a large amount of assets concentrated in a big bank that's on sides with what they're trying to do.
So you mentioned a bit about the recession. Are you a believer that the recession is really coming in strong, maybe towards second half of the year or later on, or are you a part of that?
The data says that a recession is very close. The yield curve has been inverted for over a year. The 10-year and 2-year, bond yield curve has been inverted. It's the most accurate predictor of recession out there. And you can look at all sorts of things. Earnings growth is slowing. We're in the middle of earnings season for Q1. The earnings growth for the S&P is negative with almost all 500 companies reporting. It's even worse for the tech stocks with 80% of the NASDAQ 100 reporting and earnings growth is down something like 8 or 9%. And you've seen layoffs start to materialize in the tech sector. We've all seen the headlines from Meta and Microsoft and Lyft about, the layoffs. And then if you look at other things like the ISM surveys are slowing down, they're pointing to contraction. The small business surveys are not great. The sentiment is negative. And so when you combine all that, yes, I think we have to go through a recession. The GDP is also, slowing down. We just got the number for the first quarter at the end of April, and it wasn't a negative number, which you need for a recession, but it was slowing growth. I think the number was 1.3% or something like that, down from over 2% in Q4. So the trajectory of the economy is slowing. And I think that's going to culminate in a recession later this year. Yes.
So with all that's happening, gold is actually doing quite well. It's pretty much I would say the all-time high is almost there, and it can easily break through any time, any day now. So what's the thoughts? Are we seeing a potential with the bank collapses why US dollars is going down and gold will continue to rise? Or what's your thoughts on that?
Yeah, gold has a lot of tailwinds. The money coming out of the banks, and even if only a small amount of it goes into gold, it's very good for the sector. The dollar has weakened. You had a US dollar index that was above 110 a couple of months ago. It softened down to around 100. And you've had the long-term bond yields that have come down, like the 10-year yield has come down. All of that is good for gold. What you say is true. Gold is near a record price. Intraday, it actually hit a record very recently. This month, it was over $2,080 an ounce. What I would have liked to see is a close above $2,000, which is a very important psychological level. I would have liked to see that on a quarterly or monthly basis, and we've got neither of those yet. So at the end of the first quarter, it closed below $2,000, and more recently at the end of April, they drove it down to $19.99 on the last day of April, so it wouldn't close above $2,000 for the month. Once we get one of those, a monthly or quarterly close above 2,000, I think gold can get really bullish. But nonetheless, gold is still bullish now and is worthy of buying the pullbacks. It could easily sink back below $2,000 an ounce, and that would be an opportunity to buy. So if you think about the past 10 or 12 years, where it's been, the market's mantra has been sort of buy the dips in tech stocks, right? Every time the NASDAQ would dip, you could buy and make money. Now I think it's inverted, and it's time to buy the dip in the precious metals complex until we get through this recession. And as we get into the natural end of the Fed hiking cycle, right? So once we were just talking about employment, right? Once unemployment starts to tick up, and if the Fed does cut rates or abandon quantitative tightening, it's going to further weaken the dollar. And so that's what I would be watching as a catalyst to send gold higher, is that if that DXY, which is hovering around 100 now, breaks lower, you could see much higher prices in gold. But as it stands, we're in a gold bull market, and it's worthy of buying the dips.
Great to hear. Maybe we'll spend a bit more time now on our second part of our discussion, because the main topic, main headline we're seeing is always saying, because lithium has been go on for very strong for the last almost over a decade. Is it still a opportunity right now for lithium metals in the stocks, or is it just a hype because we've seen so many things going on, talking about how EV is going to revolutionize the whole market, right? So maybe you can take a shot at that one.
Yeah, sure. Lithium was very exciting last year, right? You had the price of lithium run to over $80,000 a ton of lithium carbonate in China. You had lots of deals being made. You had the automakers announcing new battery plants. You had automakers going upstream into the mining sector, making deals directly with the lithium mining companies. And then what we've seen since sort of late last year and earlier this year is a 60% fall off of the lithium price. I mean, the price came down, like I say, from $80,000 a ton to below $30,000 a ton. And that washed a lot of froth out of the sentiment. And let's be clear, there was a lot of froth in the lithium space. You had companies, in the resource space changing from gold companies to lithium companies, or from crypto companies to lithium companies. And everybody was staking ground in Quebec, and then everyone was talking about having a pegmatite project, right? And so whether or not there was spodumene in those pegmatites, they were still promoting it. And so you sort of needed some of that froth to go away. There's other factors, right? You look at sort of where this lithium is going to come from, and you had Chile announce recently that they were going to, maybe quasi-nationalize their lithium space, which led to Albemarle significantly selling off, which is one of the top three lithium producers in the world. At this point, some of that froth has now been washed out, and I do believe it's worthy of buying quality names in the lithium space. You sent me an email yesterday about the Allchem and Livent deal that was just announced this week, and the market has been very receptive of that. If you look at Allchem stock, for example, it's gone from something like $12 to $14 on the announcement, and that's going to create a top 4 or 5 lithium production company here over the next couple of years. A lot remains to be seen with electric vehicle adoption. There's some people out there who are starting to say these aren't going to come as fast as all these projections say. I was just reading this morning that Polestar was delaying one of its cars until 2024 and was going to lay off some of its staff. So you do have some of those headwinds in terms of adoption truly manifesting the way that these projections have said. But nonetheless, I think you're going to be in a structural lithium shortage as we head into the 2030s. And the other thing that I don't think people realize is how long it takes new supply to come online. So you'll see people point to, large projects in California, or you'll see people point toward direct lithium extraction or extraction from oil wells that are going to solve the supply shortage. I've been around, I think, long enough at this point to know that it always takes longer for those new technologies to come online and for new supplies to come online. And so I've been a buyer of lithium stocks. Well, I was before. I've been in the lithium market for a long time. In the first run in 2016 and 2017, made money in the 2021 and 22 run, and then more recently have been buying, including Albemarle and a company called Patriot Battery Metals, which I own because my partner put me into it, who is a resource expert. So lithium, I think, is still worthy of investment, especially after this most recent pullback.
A really good analysis on that one. And I from the industry point of view, also they would say, for all the EVs going on, how many batteries that we need in the future. And electrification process, copper seems to be a metal that for people worth taking a look. So what do you think copper would be a good on short term or long term buy?
So copper, I think, faces the headwinds of a recession. People call it Dr. Copper, right? It sort of is the general practitioner to the global economy. And in the short term, it's been soft because everyone's expecting a recession. So you remember it ran to $5 in 2021 or 2022, and now it's back below $4. I've been saying that it could stay below $4 until this recession passes, but that beyond this recession, I think copper is one of the most or one of the strongest resource investments you can make with a long-term time frame in mind. I think we use something like 21 to 23 million tons of copper a year right now, and by 2030, that's going to ramp up to 30 million tons a year. At the same time, we struggle to add more than 1 million tons a year of production. Look at projects like Oyu Tolgoi that have taken years to expand, and the frustrations that Rio Tinto has expressed with that. Or look at the opposition by locals to projects in Peru that limits the ability of new copper supplies to come online. The copper miners also think that there's trouble ahead as it relates to copper supply. You've had some very big deals recently. There was BHP paying over $6 billion for Oz Minerals, or currently you have Glencore fighting to try to take out Teck. These companies are wanting to have some sort of merger and acquisition cycle to streamline their supplies and to get bigger as it relates to copper. And then if you look at some of the forecasts for the prices that are needed, it's going to take $7 copper to incent some of this new supply to come online. And I've read comments from Goldman Sachs analysts who are talking about $50 to $100 copper out in the future, to 2040 or 2050. And so copper in the long term, I think, is very bullish. And there's not a lot of high quality projects to invest in. So if you can find those, and some have been rewarded in the market recently, companies like Aero Copper or Foran, for example. But yes, I think copper has a very robust future ahead of it. And I've been telling my subscribers to use this current softness, the softness that we expect over the next quarter or two, to be getting positioned in that sector.
So follow up to your recession statement. So if just to talk about how soft the market will be, if the recession is imminent, so what should investors do? Like any other metals that the market that they should be following too?
Outside of copper?
Yeah.
Look, I think we haven't talked about uranium at all. I think uranium also has a very bright future, and it too has been soft in the first half of 2023. Is the recession doesn't necessarily affect uranium as much as it affects copper and oil, because the uranium has to continue going into the reactors, and the plants stay online no matter what the economy is doing. So, uranium gets a lot of hype. It's very loved by retail investors, and there's like a small group who are, constantly bullish and perma bullish, and they get overexcited. Some of those folks lost a lot of money over the past year because uranium had a very strong run in 2021 and 2022. Sort of like lithium, and then had a pretty strong sell-off where even the mid-tier producers that are listed on major exchanges like Energy Fuels and Denison and UEC had very strong pullbacks in the first half of this year. I've taken the opportunity to get repositioned in the uranium market, buying those names that are liquid and that have a big board listing. There's a lot of bullish fundamentals for uranium. I won't run through them all on this call, but we know that there's a large build out of reactors. We know that small modular reactors are coming. We know that it's increasingly being looked to as one of the major solutions for climate change, because it's base load emission free power. And so as utilities come back into the contracting cycle, as purifiers or upgraders like Converdyne come back online here in the United States, which is expected this year, that demand for uranium is going to continue to tick up. We're already in a deficit. I think something like 195 million pounds the reactors will need this year, and we're only going to mine 165 million pounds. So traditionally, over the past decade or so, that's been made up by secondary supply, but even some of that is going away now. And then the wild card is sort of these financial assets that have been buying uranium, not for electricity production, but just as a financial asset, like the Sprott Uranium Trust, or Yellowcake, for example, that are adding demand and keeping the supply that they buy off of the market. So I've given you sort of a long-winded answer there, but uranium, I think, is a good bet for a small portion of your resource portfolio if you have a 3 to 5 year time horizon.
So you mentioned about the retail side of it, right? They're really excited about uranium. You're very hot or very cold. How about institutions? Do you see any smart money institutions ready to deploy in this matter, or is there still on the sidelines?
It's tough for institutions to get involved because the companies are so small. Most institutions have a mandate that the stock has to be, listed on a major exchange or be trading above $1 or $2. In that sense, it's why the retail crowd has an advantage in the uranium market, because they're able to position ahead of the institutions. I do think there will come a time where the institutions are putting money into uranium. And I guess you've sort of seen that a little bit with Sprott as the leader, creating new ETFs. There's a new uranium junior ETF from Sprott. They obviously created the Sprott Uranium Trust to buy pounds off the market. But once the liquidity increases, I think once the bull market is further underway, I think you'll see institutions come into the space, and that'll be a catalyst to make uranium equities go higher. It's one of the reasons that uranium equities are so volatile, right? Because there's so few of them, and they are so small that once money starts coming into the sector, they overshoot dramatically. That's exactly what we saw in the 2006 to 2008 time frame. The last time we had like a really strong uranium run.
Well, that's interesting to hear. Time really flies very quickly, and that's sort of pretty much the end of our discussion time. But it's tremendous to have you here with us to share your insights on various topics about markets and about the metals, of course.
Well, I was happy to be here, Gilbert. Thank you very much for inviting me. And anytime you see an opportunity for me to speak to your audience, I'm more than happy to do so.
Great indeed. So I will invite you next time and next opportunity for sure in the future. Talk to you soon.
Thank you. Cheers.
Thank you.